Hello, my Tier 1 people. I've got an opportunity that could shape your future. I'm working exclusively with one of Australia's most promising fintech startups. They've flown completely under the radar, quadrupling revenue, winning blue chip clients, and gaining significant market share. The founder has done an incredible job so far, and it's now time to hand over business development and bring in the company's first head of sales. We're looking for someone to drive growth, the go-to-market strategy, and help scale an innovative data platform aimed at the $4 trillion superannuation industry. If you're a sales leader with RegTech, Fintech, or SaaS experience, this is your chance to join a high-impact founder and accelerate your career. Interested? Drop me a message on LinkedIn or give me a call on 0415 55 1138. Hello and welcome to Fintech Chatter, the show where I connect with fintech leaders for a bit of a chat. I'm your host, Dexter Cousins, and the founder of Tier 1 People, the executive search and recruitment firm that's dedicated to helping high-growth fintech ventures hire exceptional people. Today, we're continuing our series on housing affordability, and I'm joined by the CEO of Osco, Stuart McGregor. Stuart, welcome to your Fintech Chatter debut.
Great to be with you, Dexter. Thanks very much for having me. Looking forward to the conversation.
I'm looking forward to it as well, because when I started this series, I was thinking of you, and you reached out to me, we hadn't spoken in a couple of years, and you were like, hey, look, we're back. So I was delighted to be able to feature you. And, when we first connected, I think 2-3 years ago, I was really blown away by the way in which you were trying to tackle this problem. So I'm delighted to be able to share that with our listeners as well. But I'm kind of speaking from a privileged position in that I know what Osco is about, but our listeners probably don't. So could you share with them a bit about Osco and the area of the problem that you've focused on?
Certainly, Dexter. Started about 7 years ago. As with all good solutions, they start at home. And I had two daughters in their early 20s. And the next part of their life journey was, as a parent, how do you help them into home ownership? So I started picking at the problem. Okay. What emerged was a real, let's just say, a tangled web post the 2008 GFC of regulatory and access to capital challenges that sit alongside the housing supply-demand problem.
Yeah.
Right? So everyone looks at house price, and the column inches in the press is there for all to see on how house prices increase, how much longer it takes for folks to save for a 20% deposit, what are the alternates. But the folks focused on the house price side of it are ignoring half of the problem, which is what is the cost of borrowing over 30 years.
Yeah.
So when you start looking at the cost of capital over that period, some major things start emerging. It's more expensive for people who don't have a 20% deposit to borrow. There are lenders' mortgage insurances challenges overlaid on that. And what it does is it basically starts your first home buyers. If you're going to run a 100-meter race, it starts you 20 meters from the start line compared to everybody else in the market. Yeah. Okay. So that's really where we started looking at, is there a solution to this problem, and what would the product fit be for something that we could put into market? At the time where everybody was looking at shared equity, we looked at a shared debt solution. That was the first revelation. And the second part was whether or not we could make that debt investable. So put a financial product into market that basically funded folks' deposit gap. So the deposit gap is whatever you don't have to make up the 20%. So anything from 0 to 15%, you need 5%. Borrow 80% from the bank, 15% from Osco, and the mechanics flowed from there.
Yeah. So taught me a little bit then around, the kind of Osco business and how it's structured. Oftentimes I'll ask people to make it easier. Are you a fin, as in a financial services business, fintech, or are you a tech kind of business servicing the financial services industry? Where do you fall on that spectrum?
Right. So the thing we're working on at the moment is the realization that debt is the last major asset class to migrate to the internet. Equities has moved, commerce has moved, debt sits above 400 trillion in total assets, direct, setting aside derivatives. That has resisted moving onto the internet for a bunch of reasons, most of which get solved with blockchain and crypto, stable coins, and different, let's just say, protocols for representing stores of value, mediums of exchange, units of account, the properties of money. Okay. So what we're working on at the moment is what is the underlying architecture to support the migration of debt onto the internet. It's not just currency or just stores of value like Bitcoin or property, or there's a whole thing that has to be untangled there. And it's also tightly associated with your identity. And there are three categories of identity. Two we've known for a long time. The first one is personal. The second one is some sort of corporate organizational representation. But the one we're building for is agentic AI identities. So in a world where AI is doing business with itself, identity takes on a whole new meaning, and the ability to essentially establish contracts that have stores of value associated with them, debt being a large class of that, is part of the future architecture that we're designing for. So we wouldn't be able to do the fin without our version of the technology. The core to the proposition.
So you picked the hardest thing to do then.
That's right. That's right. Exactly. But it happened at a time when blockchain was just starting to mature in sort of 2017, 2018 period.
So the kind of ASX would have made their big announcement that they were going kind of in on blockchain around that time.
Correct.
Yeah.
Yeah, it was around that time. But what was more interesting about that part of the journey was there was a recognition that real world assets would eventually make their migration onto blockchain.
Yeah.
And that trajectory has pretty much held true. And, the last 7 years, we're not there yet, but we're in the point of the curve where the majors are starting to adopt. So it's really just a matter of time as momentum builds. Okay. There were some architectural choices we needed to make around the tech so that it would be ready for prime time literally around the 2020, 2021 mark.
Yeah.
And they didn't exist at the time. So we had a couple of technology navigation waypoints along the way. But for the most part, the fin and the tech have tracked pretty well together. Okay,
yeah.
So you wouldn't be able to do the fin without the tech. And our solution basically says if we can fractionalize a loan and make it investable as a security that is regulated, we now need the tech to be able to manage, basically fractional investment.
Yeah. Yeah. And look, I've had a lot of conversations around the whole crypto space. And for me, kind of when you cut through the noise, I absolutely agree that the tokenization of real world assets is really where the alpha is and the opportunity is. And if you look at just how inefficient the home loan and kind of home lending space is, just from a capital perspective, lenders, mortgage insurance, all of those things, such a waste of capital. And then you think of the challenge that you have around gain in equity and the property once you then get it, and then how do you actually realize some of the capital gain within that and release some of that equity? Again, really inefficient, highly complex. Talk me a little bit, because this is when you and I first met, that I was like, wow, like this is this is decades ahead of kind of where that it's thinking. Talk me through that, because I'd really like our listeners to kind of benefit from that conversation that I had with you.
Excellent. So if you take the thesis that, exactly as you said, fractionalizing equity and releasing it is a real challenge, the feature with debt is it becomes a lot easier, right? We already have a body of practice around unit trusts. So folks are pretty adept at understanding what a unit in a unit trust is, how we price it, and how we could exchange it, right, from myself to yourself. So there isn't a titles office in charge of that problem. And that was the early indicator for us to go to a shared debt model rather than a shared equity model, where at that time in the late 20 teens, everyone was trying to figure out how to fractionalize property itself.
Yeah.
Okay.
Yeah, so we had like Brick X where you'd kind of buy a brick in a building, and yeah.
Exactly. The next challenge that needed to be solved was, can we keep that tradable asset coherent across time, right? So if I issue a loan as a borrower who needs to fund his deposit gap, and you invest in my loan and you buy, say, $10,000 of my $100,000 loan, and then you decide to sell that asset to Fred down the road, somebody needs to be able to track the provenance of that debt.
Yeah.
Who does the coupon payment get made to? Where does the value of the asset reside? All of the issues that come associated with that. All right. So that's the second part. The third part is comes back to this real world assets question, which is, if I can do this for a $100,000 loan, which is effectively a home loan, the security, it's not quite a mortgage, but it behaves just like a mortgage.
Yeah.
There are a number of other use cases I could apply this to: syndicated loans, private debt, commodities finance, asset-backed securities. They're just different permutations of a fractional debt structure. So that's the roadmap that we were looking at when we last spoke. And what the deposit gap loan is the minimum viable product proof of concept that this thing actually works and is scalable. Okay. Now, the fact that it fits into a niche where both the pros and the cons, the first part on the pro side is that it can demonstrate way more efficient use of capital in the first home buyer situation, because it has this unique set of problems around cost of capital, regulation, and all the rest of it. So that's the small niche but highly juicy proof of concept. And then it's a question of, where do we scale this into the market, into other use cases?
Yeah.
So that's where we're at the moment. It's a bit of a watershed moment, because we're watching the rest of the world mature into a place of, this is now acceptable.
Yeah.
And as that watershed starts emerging, we're going to start seeing other use cases emerge for exactly the architecture that we've built.
Yeah. Now, we've talked about the complexity of tackling a problem both from the financial instrument side and the technology side. The other complexity is that you're really talking about products that don't exist, that a regulator will look at and go, what the hell is this?
Yes, that's right.
Talk me through the journey that you've had and the conversations that you've had with regulators around how do you kind of, and look, the kind of other challenge that I would say as well is, if you mention crypto, fintech to a regulator, it's like, oh. So you've kind of come at them with what I would say is like a 99.9% chance that they're going to say no. How have you navigated that?
Yeah, so look, I've been around the block a few times. The last thing you do is walk into a regulator with a crypto proposition.
Yeah.
And you say. So what we did was we partnered with some amazing organizations to help us figure out the problem. And one of them provided some debt capital for us. The other one was a top 10 Australian bank. One of the large mortgage aggregators, mortgage broker aggregators. The confluence of probably 5 years of work to get a pilot into market during 2023. And what we had to do was effectively stand up a non-bank lender and introduce a responsible lending compliant product into market. So what we had to do was make it look exactly like a home loan that would sit alongside the 80% loan. And we managed to clear pretty much all the hurdles to make this loan look like any other loan. The fact that the underlying part of the operating system is blockchain based isn't of any interest to a regulator.
Yeah.
So all we're doing is we're using Australian dollars in, Australian dollars out.
Yeah.
Whatever happens
so
below the surface.
So it's effectively a general ledger, right? Like, which is what a blockchain kind of is. Yeah.
Correct. And once we managed that separation, regulators had regulatory questions. We had pretty much standard answers. It looks like this, but it has these features to it, and this allows borrowers to get these benefits and investors to get this set of benefits. And While it was still slow, I mean, it took us 2 years to get through just one approval process at ASIC. We would have stood zero chance if we'd introduced any complications into that process.
Yeah. So kind of talk me through then where you're at now with the, I guess, the solution and the business, and kind of what you see as being the future opportunity. Because obviously the biggest challenge is that if we talk about 7 years, the last 7 years, like the world has kept changing constantly. Technology's like almost it's unimaginable where it is now. Kind of back then we were talking about Bitcoin being at what, $2,000 or something like that, right? And so the kind of the whole landscape has just it's just completely different. How have you now kind of looked at the proposition to say, right, kind of this is now what the next 7 years is going to look like, and this is where we need to focus our energy?
Okay, great. So look, there's a few ways to come at the answer to that question, Dexter. The first one is 7 years ago, we realized that we needed a 7-year at least guess at what the technology trajectory was going to provide for us. Okay. We had to make some architectural choices around what was available at the time, and we started building on essentially an Ethereum derivative called Quorum, which was basically a JP Morgan version that had stripped out all of the proof of work stuff at the time. Then we migrated to a Solana and a Hyperledger architecture. It was a pretty simple migration because the cost base was lower and the feature set was richer. And we're pretty confident that that architecture is now going to be cost effective for the foreseeable future. So let's say another 5 to 7 years. Okay. So now that we've bedded that down, what it allows us to do is say, all right, what is decentralized Solana? What is, let's just say, distributed or local? So I'm a non-bank lender. I need a ledger that my auditor can get to. I build that on Hyperledger. I've got an execution fabric that runs on Solana. I can operate that from anywhere in the world and it's accessible. So I've got this sort of hybrid, decentralized, distributed type architecture. It all runs on AWS, so I can configure an instance remotely, and I can essentially build a non-bank lending operating stack in a super compressed time frame. Okay, we're talking single-digit weeks rather than single-digit years. Okay, which is your traditional banking sort of approach, right? So we're highly confident that the variability in blockchain is now, let's just say, predictable enough for us to be confident that we'll be able to cycle any engineering and architectural changes through the system at a far greater pace than the rest of the world will be able to adopt it for its first incarnation. Okay, so we're still seeing banks running around trying to choose a token to try and figure out how to tokenize real world assets. With all due respect, if we hadn't solved that problem 5 years ago, you and I wouldn't be talking. All right. So we're going to sit and wait for everyone to play catch up. And if we have to change lanes, we'll be ready to do that. All right. Yeah. I think the cliche is roller coaster. It's a bit of a, but it's. Let's just say we've managed to achieve what we needed to at the time in our evolution as appropriate, right? So early on, it was lean, a lot of design work, a lot of architectural sort of proof of concept. Will this work? Won't this work? A lot of time with lawyers. Can we get this compliant? What's the business model need to be in order for this thing to work? Okay. So let's call that there's probably a 3-year period there. Then we raised capital to be able to put our product into market. And we managed to get that in a portion of, let's just say, equity and debt. So the equity part kept the lights on. We could grow the team to expand to be what we needed to be, and also the provision of some debt capital to be able to test the loans in the market. All right. That essentially culminated in the pilot with the banks, and we put half a dozen people into homes. So we got real home buyers into homes. And, I suppose the headlines there was a couple of things. First of all, borrowers really liked the product once they understood it, and we onboarded about 40 brokers who opened up their funnel. We managed to get sort of 20 applications in, and we got 6 folks into homes in a 6-month period. Okay, so it was a real world 6-month journey to go and arrange the finance, find a home, settle, and get in. The headline for the home buyers was we could cut their 30-year borrowing costs by roughly 15 to 20%. Okay, we cut their minimum monthly mortgage payment by around 15%, and that averaged about $1,000 per home buyer at the time. So, when you're paying $4,000 on your mortgage and you can get $1,000 off, that is not quite that, but you're sort of in the ballpark where it's meaningful money for these folks. The interesting thing, though, was for the bank, we found that the deposit cap loan plus their 80% loan would outcompete any other bank's proposition with LMI. So all of a sudden, the bank was going from not even on the field to top of the podium. And brokers loved that because they could bring a proposition to borrowers that no one else had. So we managed to get this thing into market with that funding, responsible lending compliant, non-bank lender into market with funding for the first few loans for the pilot. Where we ran into the challenge, and you've got to remember the timing is always critical in this. Back end of 2023, interest rates started rising. They went from 2% to 6% in a few quarters, and the whole cost of capital landscape just changed dramatically. So we ended up having to pretty much go into hibernation mode at the back end of 2023. And what we're figuring out at the moment is what is the access to the funding capital that we need to start developing. And this is where we get to the heart of the problem with the cost of home ownership in Australia. It connects back to the systems that we have in Australia. Essentially, our major financial systems are banks and supers. Now, a lot of what we're talking about at the moment is how do you solve the bank problem in terms of cost of capital. The other side of the equation is that what superannuation has done over the last 30 years is it's disconnected, first of all, the bank of mum and dad's nest egg from supply of capital into helping their kids into homes. And it's also taken early, let's just say, recently qualified, new to the workforce, grabs 12% of your salary, sticks it in super, you can't get that, right? If you've got HEX, well, good luck, we're going to grab some of that too. So the ability for sort of early productive folks to start saving towards a home deposit is also disconnected from what it used to be a generation back, right? So you have this compounding effect of super disconnecting our ability to help early home buyers into homes, and you've got this cost of capital problem where borrowing costs are 30% higher if you don't have a 20% deposit. So you end up with this time to value problem where the dilemma is I can sit around and save for 15 years for a deposit, but then prices are just going to run away from me, or I can bite the bullet and take LMI. All right. So to bring that home, one of the challenges the super was set up to solve was to provide for people's retirement. What we've worked out is that life is 50% more affordable as a homeowner than a renter. And so when you do the math over a 30-year period, you're about 50% better off as a homeowner. We all know that instinctively. The real challenge is that our super is being invested offshore. So it's chasing investments in markets that don't solve the problem at home. So what we're trying to figure out is how do we get access to those pools of capital? We can deliver, let's just say, low double-digit returns, which outperform super. But our challenge is we don't have the scale yet. So it's that crossing the chasm. Can we get to the scale where that starts making sense? Okay. So that's the problem we're solving at the moment. And if we can connect the demand side to the supply side, we can get super involved in this. It's a win for the banks. It's a win for society through super. And yeah, that's our so that's the thesis we're working on. Yeah. Right now, you can hit me up on LinkedIn, Stuart McGregor on LinkedIn, Osco, OSQO. That's right. Excellent. Thanks for the support, Dexter, and I look forward to staying in touch. Thanks, Dexter.